Welcome to the latest episode of the FRP podcast, where we'll break down what's really happening in the world of special situations and M&A. I'm your host, Ceara Roopchand, and today we're diving into the key themes emerging from the recent SSA roundtable convened by R3 and expertly chaired by Felix Connolly of BTG Advisory. Joining us on the mic today are three brilliant voices from that session: Felix himself, Louise Durkan from Deloitte, and Ben Hughes from FRP Advisory. We'll be unpacking the mood of the market, the evolving role of private equity, and the shifting sands across sectors. You'll hear firsthand about why mainstream M&A has hit a pause, what's driving the rise in special situations activity, and how deal makers are navigating delays, valuation gaps, and political uncertainty. So whether you're in advisory, private capital, or just watching the markets closely, this episode is packed with insights on what to expect over the next 6 to 12 months. Let's get started. Thank you for coming on to the R3 podcast. So let's start with some introductions.
Hi, my name is Felix Connolly. I'm a partner at Begbie's Training Group. We're an insolvency restructuring practice that operates from 100 offices nationwide. I'm the head of deals advisory nationally. I have 20 years experience in the transactional arena, with experience as both an advisor, lender and investor.
Hi, my name is Louise Durkan. I am the pay lead for special situations M&A at Deloitte. I have a national role, but also looking across our global network, looking at all kinds of specialist transactions of an M&A variety, everything from complex carve-outs through to distressed transactions. I've got a little bit more than Felix, just over 20 plus years worth of experience. I'm also an insolvency practitioner with a lot of experience in and around all kinds of restructurings across a variety of sectors.
Hi, my name's Ben Hughes. I'm a partner in the corporate finance team at FRP Advisory. I've been with the firm for 1 year. I actually started my career out in restructuring, got back in about 2002 now, but moved into corporate finance in 2010. And having done a period of mainstream and special sits M&A, I decided to dedicate myself to special sits M&A in about 2018. Work on a variety of situations involving companies at different stages of the stress and distress curve and across all sorts of sectors.
Let's start with a summary of the current state of the M&A market. Ben, what's the state of play and how has it evolved over the past 6 to 12 months?
So I think it's fair to say it's been a bit of a disappointing 2025 for my mainstream M&A colleagues. I think 2024 saw quite an uplift, certainly in terms of deal values, compared to 2023, which is quite tough for the mainstream M&A market. And I think people entered 25 thinking that there was some positive momentum building and that they were going to see a real increase in transactions getting across the line. I think it's fair to say that that optimism has faded slightly as the year's gone on. And I think that's partly driven by continued political uncertainty, and in particular the tariff dynamic that we've now got in the US. And it's just very difficult for companies to kind of know what way things are heading as the policy dynamics change on quite a regular basis. I think another factor that the teams are facing, which is quite frustrating, is how long it's taking deals to get done. Processes used to take 3 to 6 months. I think now everyone's saying they're going to take 6 to 9, even 6 to 12 months. So, it is a slightly challenging market, but for all the caution, I think it remains the case that there is an appetite for businesses that have a clear value proposition, which can be well communicated through a solid go-to-market strategy.
Thanks, Ben. I think that's consistent with the feedback we're receiving from our M&A teams, actually, in terms of output. I would take a pause just to reflect and say that this slowdown in mainstream M&A activity is having an impact in the debt markets, in the private credit and ABL markets, where there are less mainstream performing transactions being concluded. And what we're actually seeing is a lot of ABL and private credit activity in the SME space and the more distressed side of the market. So we're finding transactions which we think would ordinarily have been going into a process now being refinanced by ABL and private credit as those particular players in the M&A market look to deploy capital. So that's probably a slightly different dynamic in what we're seeing.
And Louise, what are some of the major themes you took away from the recent roundtable?
Yeah, and I guess just picking up on what both Ben and Felix have just noted across the group that we invited to the roundtable a number of weeks ago now, actually, from the time of recording. But nevertheless, those themes, I think, stay true. There was that acknowledgement of slowdown in mainstream markets. and levels sort of in terms of activity depressed on that basis that we've just talked about, and an expectation, I guess, of a slower recovery in that mainstream market over the next sort of 12 to 18 months. But noting, I suppose, as a result that there was some uptick in the special situations M&A, but that still remained fairly uncertain because of comments that Felix has been making around alternatives being considered and some sort of delay in decision making. Certainly a mood of wait and see approach by a number of stakeholders who are exposed to these underperforming businesses across the UK, with a hope of recovery in trading conditions. But as we've seen, that uncertainty continues to play out across a variety of changing moods across the political landscape as well. And certainly that sort of position around sort of credit funds and private equity investors delaying action in some cases, wanting to avoid crystallising a loss, that having an impact on some of the mainstream disposals and processes being paused or aborted in some way, shape or form. But certainly from our perspective, highlighting that need to have some optionality on alternative options and some form of contingency planning. We'll come on to talk about it, I'm sure, but there was some reference again to ageing assets, especially from COVID era investments, some expectation gaps between sellers and buyers remaining challenging, many citing, failed processes as a consequence of that particular matter. And then we talked a little around sectors, and I won't steal Ben or Felix's thunder on this, but, we covered off a variety of sectors, nothing too startling and nothing too surprising, the usual sort of suspects around consumer sectors and other infrastructures, but we're going to talk about that again in a moment. So we'll cover that in a bit more detail, I suspect, as we go along.
And another thing I think which everybody agreed on was kind of how the growing influence that private credit is having on the special sits market. The way private credit funds operate is very different to the way your high street banks can operate. And, as the phrase goes, a rolling loan gathers no loss. And I think what we've seen over the past 3-4 years is actually the volume of special sits M&A opportunities has probably been slightly lower than expected. And that's partly driven by this rising role of private credit funds. And when things start to go wrong, unlike some of the banks who may decide, well, actually, we want to exit these positions, we're seeing the credit funds take the keys, or if they're not taking the keys, putting in more liquidity to continue to support the business. And I think, that's going to continue because they are now a very big stakeholder in the lending market.
One of the themes that came from the roundtable was really there's quite a divergence between the value expectations for buyers and sellers, which lead to a lack of development or completion of transactions. That's a factor that's been influenced by COVID, I guess, the number of macroeconomic shocks that have been experienced across the UK and wider global economy, which do make it more difficult for buyers and sellers to agree on what normal trading looks like.
So, Felix, with the uptick in special situations activity, what types of opportunities are investors currently gravitating towards in this space?
So I operate really in the SME space, and I think what we're seeing is special situations investors really gravitating away from more conventional M&A processes and really starting to focus on targeting more non-core carve-outs, which have very different conditions attached to the transaction. So what we're seeing in that lower SME space is actually there are more processes which are less competitive than pre-COVID, which presents rich opportunities really for trade-backed PE to acquire complementary businesses into existing platforms at value. Or increasingly, we're seeing trade certainly being far more active than they were prior to COVID.
Yeah, and I'd echo that. And even when you kind of move up to some of the bigger deals, I think, some of these investors might phone me up and have a go. But I think it's fair to say that some of the turnaround funds that a few years ago would be at the top of your list are probably less willing to look at hairier situations than perhaps they once did. And, obviously buying business through a pre-pack can come with its challenges. And I think some of those funds, again, ideally they wouldn't do pre-pack acquisitions as much, and they're more focused on carve-outs. And I know that's an area, Louise, you've been pretty active, so probably you've got a good view of how they're behaving in those processes.
Yeah, thanks, Ben. I'd say that's been the sort of typical project that I've worked on over the last probably 6 months or more, a couple live as we speak. So yes, I'd agree with that. And I'd say there's a mix in there. Those funds that we would have typically seen at the more stressed end, and you're right, around those kinds of transactions that require a pre-pack. So looking at those very stressed, very time compressed processes, I guess the feedback I hear from them a little is around the quality of the assets, time available, liquidity runways being challenged, and that's probably echoed by a number of our sort of fellow professionals that say, notwithstanding everything we say continuously forevermore is come to us early, and the earlier you come to us, we have more options available to you. But that continues to be a theme. They are gravitating, therefore, more towards a sort of carve-out environment, looking at those sort of unloved, maybe underperforming assets, which have that sort of edge to them in terms of opportunity. Maybe there's some operational turnaround, maybe an element of sort of financial restructuring that's needed, maybe a refresh around management and energy and efforts into strategy. But they do see those as more appealing transactions where I guess the sort of the opportunities are drying up in the usual places. The other thing that I would say is probably in that same period of time, more so than ever in an awfully long time, there's new entrants into the market that are regularly wanting to come and, I suppose, explain to me what their fund does, what they're interested in doing, their expertise, and what the type of assets they're looking at. Also, we get family offices now increasingly that maybe there's been a sort of a founder that's been very successful in other special situations funds previously, that have set up their own fund and spun it out into a family office who have that skill and expertise and are more confident in the area to come at it new. So we have certain funds, certainly in the last week even, that I've been speaking to where they've just got a handful of assets in their portfolio and are very thoughtful, don't necessarily do many transactions a year, but are looking for those slightly more challenging carve-outs that we see. They're not without their challenges, obviously, and we do get into that space where not everything is a value transaction. Some of them are a pound transaction, and some of them are dowry transactions with substantial dowries, I'd say, that sort of need to attach to them. So it is a changing environment from that perspective, and some new entrants, some experienced ones, but certainly a very different landscape that I've seen in, say, 6-12 months of the last year.
And I think actually picking up one of those points, and to be fair to some of the turnaround funds who I just slagged off, although I think that is a fair comment. And, we catch up on a regular basis, the three of us, and, a common gripe of ours, which we've been having for a number of years, is post-COVID, quite often boards are making decisions later than they used to in terms of bringing us in to prepare and subsequently launch a sale process. And so I think you're right. There are situations when we're coming in so late. It's not just that the timetable's really short, because again, the turnaround funds in theory should be able to move quickly, but it's just the business has been running on fumes for so long that actually the quality of the asset has just been destroyed. And, that some of these funds will look at these opportunities and go, well, look, the cost of actually trying to get this business back to break even is just far greater than what the potential return could be once we kind of get it to grow. And therefore, they're not choosing to pursue these opportunities. I have got, some sympathy for some of those turnaround funds that aren't looking at some of the deals that once they perhaps did. And I think, as I say, that's partly because some of the businesses coming to market that we get involved in, you just wish that we got the call 6 months earlier, because I think with the longer runway and with the business in a slightly better shape, then we probably could have got, better exit.
I totally agree with you, Ben. You're kind of spot on there that I suppose boards and therefore other stakeholders involved in these businesses, they are literally pulling all the levers that they can, because there's not been a trigger event, because everybody's been concerned about value and sort of, crystallizing a position at the wrong time. So you're absolutely right in terms of runway, cash, the business itself, and frankly, the sort of energy and effort that goes into all of that. You do get a very weary board that it is incredibly difficult for all parties concerned to actually get those processes working and actually find a solution that is rescuing a considerable proportion of that business and actually has the ability to sort of make sense from an investment committee perspective.
Another theme that was raised at the roundtable was pertaining to COVID-era investments hitting their 5-year mark. Felix, how has this influenced an exit strategies, especially given current macro and political uncertainties?
So I think ordinarily, for those unfamiliar with special situations M&A, private equity would usually invest over a 3 to 5 year horizon, I guess. So we should be seeing the exit of investments made just post the lockdown, the relaxation of lockdown, actually. So I was actually in private equity at that point in time investing, and the values ascribed to businesses was very, very high, reflecting a pent-up demand from investors to deploy capital post-lockdown. So we were seeing businesses that were being traded significantly over what we assessed at market value when I was in special sits M&A. So we're now looking at a point where those assets should be coming to market, but those markets were acquired at a premium, I guess, and then you're reliant on growth to drive a return. But we've witnessed sluggish economic growth post-COVID, driven by macroeconomic shocks. We've seen cost of borrowing increase for interest rate rises. We've seen cost inflation throughout the supply chain and labour costs. And what I suspect that means is that a number of these funds have not been able to generate the return that they would like to, and may in fact be sitting on negative equity, I guess, in terms of their investment based on market testing. So, based on some analysis that I did earlier in the year, there's a historical high of 3.2 billion USD of unsold assets held worldwide from private equity. And those assets we're seeing being taken to market because we think that would likely see a loss across a number of those investments. So there's very much perhaps they'd kick the can down the road approach that's been taken with some of these COVID era investments. But that's now being tempered, I guess, by pressure from LPs, so lending partners into private equity, to return capital to them in terms of their investment cycle. So I think we're seeing a lot of hold strategies for assets and investments we would expect to have been realised from COVID investments now.
Yeah, and a couple of points for me. I think one, that's supported by the view that we're seeing an increase in the use of continuation funds, which is when PE houses then set up a continuation fund to in effect buy assets that in a fund that's nearing the end of its term, and by doing that they then can hold the asset for longer, hope it kind of starts to grow quicker, and that actually when it comes to exit, the market dynamics are better, so therefore they'll get the return that they're hoping to get. I think one of the other points from the COVID period, and I've got a few situations on my desk at the moment like this, where there are businesses out there that boomed during lockdown. Everyone was buying hot tubs, things like that. And some of these deals were done at a time when people were very keen to get money out because they hadn't been able to get money out for a period of time. And kind of their view of what the new normal wasn't quite reality. And so, the combination of businesses just not getting anywhere near the forecast profitability that was predicted, combined with higher interest rate environment, political uncertainty, etc., that's just made it very hard, I think, for COVID era investments to deliver a great return. And that's why I think you're seeing, a number of them just being held for longer than originally planned for by these houses.
And I guess there's some echoes of that kind of sentiment within, if I just sort of post back to the carve out scenarios that we're talking about, there's an awful lot that's playing out that is very similar in nature, where you have larger corporate in this instance that are sort of holding the equity in these businesses, and equally they see those challenges around performance, the timing of maybe they did actually sort of invest, and maybe they acquired or merged certain operations over that similar period of time. And what we see coming through those sort of corporates is a challenge around what kind of returns those businesses are making back to the centre, and where they themselves are looking at cost reduction programs, looking at performance improvement strategies. A variety of cost out programs will inevitably look at sort of trimming the businesses as they stand, but in some cases they identify low productivity or parts of their divisions where they can get greater sort of efficiencies by restructuring in some way, shape or form. And I see maybe why we are seeing some of our special sits investors gravitate towards more carve-out situations, is what you end up with is a very typical exit of a business that has got all those kinds of challenges around them that we would otherwise have seen coming out of the sort of what's being held within private equity. So bizarrely, why are private equity holding on to those investments or sort of kicking the can a little for all those reasons, but equally why are larger corporates perhaps looking to get out of those businesses a little bit sooner than otherwise they would have, because they themselves have all those same pressures around cost saving and looking to see a return on their investment. They have, I guess, the ability to do that in a more measured way. And in some cases, they may have a few car crashes within their businesses that they need to exit from. So I think what I see is the sort of two sides to the story, I guess, across our market, depending on ownership and where the equity plays.
And looking at things from a sectoral basis, Ben, what are you seeing at the moment in terms of sectors that are facing the most distress, and which are unexpectedly active?
So I would say, firstly, it's across a lot of sectors, but any company that's got significant exposure to US and the tariffs, I probably need to be a bit careful what I say, because I don't want to end up in alligator Alcatraz if I slag off what the US are doing at the moment. But that's having a big impact. We've been in discussions with a business, and they had a lot of stock on water heading over to the US, and the tariffs that they had to pay on that stock went from about 20% to about 120% overnight. So any company that's got exposure to the US is probably in a bit of an uncertain time. In terms of specific sectors, I think consumer-facing sectors, unsurprisingly, are going through a challenge at the moment. We got cost of living crisis. I think, the tax burden is increasing on the public, and the cost of buying things is going up as well. So, retailers, hospitality, I do think it's quite tough out there at the moment. And I think there have been a few hospitality casualties in the last month, including pub groups and restaurants. And I think we could see some more of that. Another area where we've been quite busy as a firm is in the tech space. And this kind of goes back to that COVID era discussion we had, because, during that time, there was a lot of money put into tech companies that were going to be the next big thing, whether that be clean tech or med tech or, biofuels or something like that. But a huge amount of money has gone into this part of the market. And while some have, taken that cash and developed products which are going to change the world and are going to make billions for the investors, there are a lot of businesses out there which haven't quite progressed at the pace at which the investors had. So these companies are still pre-revenue or they're early stage revenue, despite being given, 30, 40, 50 million pounds of investment to create something. So I think tech is an area where I think we'll see more casualties as these companies realize that, what has been a reliable funding stream just dries up.
Yeah, and I think coming back to some of the themes, Ben, that we were seeing across the round table, I think there was a call out on EV as well for very similar reasons to what you've talked about around sort of the tech investments that are out there. General nervousness around consumers, across the infrastructure, a sort of a moral or sort of burning obligation to sort of do something better in terms of emissions, but also a nervousness around reliability. And certainly I've seen a bit of a theme across that particular sector myself, some of which, are businesses where, that frankly, again, not quite pre-revenue, but quite haven't really got to the place in terms of size and scale that they'd expected to. And maybe some government intervention around subsidies and support and extensions of time, I guess, around sort of conversions and continued support into the auto markets as well. We're just seeing a mixed view as well within that particular subsector.
Yeah, agreed. And what I've seen in that space is there was quite significant investment in scaling up facilities to grow that EV and green renewables markets. You've got really well invested sites where they don't quite they haven't had the forecast capacity that they were expecting. And actually, that has created opportunities for special sits funds actually to come in and acquire well invested new sites that are future proof at a material discount and right size the cost base of the business so that they're primed to grow on a reduced cost base. I think in terms of another obvious sector we've seen challenges over the past 5 years is construction. Clearly, you've seen a number of high profile cases such as ISG, etc. One, I guess the Labour government had ambitious plans to really generate significant residential new builds. That hasn't quite materialised, I think, and there's definitely signs of stagnation still in that specific subsector of construction, with very low levels of growth forecast over the next year or so. And, there was a high level of corporate failures in the residential construction space in the first quarter of this year. So between January and April, there are 840 UK construction businesses that collapsed, which was the highest recorded figure for a comparable period in more than than 10 years. So again, that's a sector that's really struggling. I think just to counter that, I guess, I've supported sectors that are outperforming or performing less than expected. I've been working with a business that supplies into subcontractor into the defence sector, providing fastenings for military vehicles, submarines, boats, etc. And that's the business, and that is a sector where, as a result of Russia-Ukraine and increased government spend, I think the UK is forecast to increase from 56.9 billion into defence in 24-25 to 59.8 billion next year. That is a sector where we are seeing actually outperforming expectations. So there is hope out there, depending on what sector you're in, I guess, just to provide some counters.
Yeah, and I think that's it, Ria. I think that's a really important point. Across all sectors, and obviously some sectors, it's easier to sell business in some sectors than others. So, what do I mean by that? So, for example, if you go back to my point on tech, not many turnaround funds are interested in investing in the tech space. Likewise, actually, there aren't that many turnaround funds that like retail. But having said that, across all sectors, there are businesses out there that are facing challenges. Maybe it's because, they've just had a problem with the management team, or they made a bad decision, or they've got a bad balance sheet, but fundamentally there is a good business there. It just needs to be acquired by someone who's got the capital and the expertise to help turn the business around and get it back on the growth trajectory. So, I think we'll continue to see opportunities across all sectors. And, I think we'll continue to see a reasonable amount of interest in those from the turnaround community. Because as I say, if there's a good business there, but it's got a bad balance sheet, then, there's going to be a lot of interest from those market participants.
And I suppose the final one to throw in there, which is a bit of a curveball, no pun intended, is sports businesses of all shapes and sizes, and sort of there's an awful lot of opportunity out there, but equally a lot of challenge in some of those businesses across sort of rugby, cricket, football, all different levels and all different levels of sort of professional status across those clubs and those organisations. I know Sports England have a programme where they are looking at supporting some of those more challenged clubs and operations, and it continues to be a place where stress appears. Again, when we look to sort of ticket prices, ticket sales, cost of infrastructure, investments into the freehold, the grounds, the stadiums, etc. I mean, you scale it up to some of the larger clubs, and we do see how that plays out more so in the media. It's not a sector that I personally profess to have much experience of, and those that know me know I detest football and rugby. But it nevertheless is something that we do see. We have a specialist sports business group, and they do a lot around both the funding and the investment into that sector. So I guess we see more of that, like I say, on the larger scale. But certainly there's been a number of difficult situations that I know people have been looking to see what the solutions are for those kinds of organisations and those kinds of groups, which don't typically follow the sort of traditional corporate structure and governance that we're all used to working with.
And with SMEs in mind, Louise, what is the outlook?
Well, I guess we've covered an awful lot around what we're seeing and what's happening in the market. I suppose we continue to face uncertainty. I think that's fair to say. And I'm conscious that what we think is the political situation today may not be the case tomorrow. And I think that runs true to businesses and organisations that we look to work with and support. They just struggle with forecasting. They struggle with, the predictability. What is normal becomes incredibly challenging for these businesses. And as we don't see specific trigger events happening in all cases, or even when they do, there's all sort of alternative solutions, refinancing, etc., that will be contemplated. There is, as always, debt maturities that we see on the horizon. We do track them over time. We are looking at, I know Felix does as well, we sort of look at what's coming up in terms of the debt positions and debt trackers, and I'm sure Ben has his own systems and monitoring in place as well. It's a sort of common thing that across our market we would do. And there are more and more of those maturities coming up over the next couple of years. And again, we don't start using frightening language like cliff edge or anything along those lines, but you can see that with all the various different delays or holding patterns, and certainly sort of just trying to find any other solution or any other way forward. There has to be, over a period of time, some of that has to unwind. Now, what does that mean in terms of practical situations? In most cases, M&A is a very, very good tool to find a way to restructure a business. Yes, financial restructuring is one way forward, but M&A is always a solution that we would want to be pushing and want to be discussing. I do hope we don't see a significant increase in failures where businesses can't be saved and there can't be a solution for them. But I undoubtedly, and I'm sure R3 will report our insolvency stats as we go along, and I know they're slowly ticking upwards as well. So I think for advisors, it's being there when we need them with the whole toolbox at our disposal, because you genuinely aren't really clear on which way certain situations will pan out, either because, as we've talked about, sort of available buyers in the market, buyers' appetite, pricing, value expectation, not just from businesses, but from other stakeholders within those businesses, will continue to be challenging. We don't predict sectors because we always get them wrong when we do. But equally, as Ben said already, it isn't necessarily about one sector or another. It's about the fitness of the business, how well insulated it might be and how well prepared it is for future trading. And I guess I'm always going to be positive in terms of our ability to help and support. But, we have to be flexible with our toolkit and flexible with our solutions. We have a number of them at our disposal, and it's just more about seeing what comes down the line when it does, because I don't see us getting quieter, that's for sure.
And thinking about the next 6 to 12 months, Felix, what should investors and advisors be preparing for?
I think in terms of investors, I guess there's probably a focus on portfolio businesses given macro uncertainty. I think clearly, portfolio businesses will be struggling or are feeling the impact of the last budget with national insurance contributions, loss of rates release, etc. So investors will probably be looking to shore that up, and clearly there's potential, and there's reference to a potential 20 billion hole in the UK's finances going forward. So there's expected to be increased taxation potentially at the point of the next budget. So all of that, I guess, does indicate a continued difficult trading environment where there is cost inflation, there is additional cash pressure, and actually navigating portfolio business through that period is likely to be the focus, which I think is why there's been a pivot from more distressed M&A into more corporate carve-out activity. There isn't quite that overarching level of distress. So I think that's going to be a focus for investors, and I guess for advisors, we need to be on hand really to support our funds who we work with, and generally UK PLC, I guess, as Louise has referenced, with finding solutions where there are liquidity challenges as a result of the macroeconomic and trading conditions.
Yeah, and I'll just add, I think for investors out there with companies that they've taken out costs and restructured the balance sheet once or twice, if the business is continuing to struggle, then get a view from an advisor on what an exit would look like, and start thinking about moving on to new investments rather than spending more time with an existing investment, which is kind of heading in one direction. And going back to that earlier point, the more time that an advisor has to prepare the business for sale and to market the business, the more chance you'll get of getting a positive outcome.
And finally, an open question to each of our contributors to today's podcast. If you were to highlight one opportunity or one risk in the M&A or restructuring landscape the remainder of 2025, what would they be?
For me, I'd say one thing, and Louise touched on this earlier. So we've been introduced to an increased number of overseas investors and family offices that hadn't previously explored special sits opportunities. And I think it will be interesting to see if any of those parties do end up making an investment in the UK via a special sits deal. And I think, there's always, they always say, oh yeah, we can move fast. We can make decisions quickly, and we're really keen, and we're happy to buy from an administrator. We understand no reps, warranties, etc. The proof is in the pudding. But having said that, I have had an increased number of meetings with new entrants to the market. So that's kind of an opportunity area, and they could end up being good parties to exit to for funds that are looking to divest challenged assets. I think a risk in terms of special sits M&A activity, restructuring activities, if there's a continued period where decisions aren't made and cans are kicked down the road, and that, which could lead to just some more inertia, and we don't see the level of activity that certainly my team is hoping to see. We've had a busy 12 months and we think we're getting busier, but I think that is an area which could dampen the level of activity we have as a team at the moment.
I think in terms of, I'd probably just use one for both opportunity and risk to the markets. I guess businesses need stability to plan and trade profitably. So the risk and the opportunity really is around macroeconomic and government policies. I mean, clearly, Trump with the tariffs has created quite a huge amount of uncertainty around exporting businesses. And I guess, a move or softening of this position could materially improve the trading outlook for businesses. And equally the risk, I guess we've talked earlier around impact of increased taxation, plugging gaps and how that might impact businesses who have already experienced significant rise in national insurance and loss of business rates release, etc. That's a real risk and is all beyond the control of the participants in the M&A or restructuring market.
Going last is always difficult, isn't it? Because everybody's already said the obvious things that you want to echo. And I do agree with both Ben and Felix's observations. I also think that there is an opportunity where we have got, Ben's point around the new entrants to the market. I think that is interesting. Does that get better competitive processes out there? I agree with a note of caution around experience and can they, put their money where their mouth is, quite literally, on some of those transactions. But hopefully it creates a sort of more competitive environment from that sense and brings more opportunity to rescue businesses as a result. And I guess the risk that, if we had a significant uptick in companies needing our help and our support, I do still feel that some of the banks and some of the teams and the workout teams that we would typically work alongside are going to need a lot of help. Those teams have changed over time, and I think there isn't necessarily the breadth of experience that sits within those teams. So from an advisor's perspective, I'd say, we need to be on hand to help them navigate through those challenges. And that's something that we certainly are keen to do. Going last has been my downfall on that occasion, and I was desperately trying to find some hot tub reference to pick up on Ben's clearly bought a business or a hot tub of that over the COVID period, but I couldn't think of anything witty to add at the end, Ben.
I don't own a hot tub. Already rumours start. I'm not selling a hot tub business either before I get any complaints from hot tub companies.
Well, there's a lot there for our listeners to take away. Thank you all for your contributions and for your insights and takeaways from the roundtable that was held earlier this year. And I look forward to having you back on the podcast soon.